Here's a number that should bother you. Roughly 30% of all new vehicles leaving dealership lots today are leased, not financed, not paid in cash, leased. 30%. That number has nearly tripled over the past 2 decades. Not because cars got worse, not because people got smarter about transportation, because one number, the monthly payment, became seductive enough to stop people from asking about any other number. And in finance, when something is designed to make you focus on one number, the important numbers are always somewhere else. I spent 30 years on Wall Street. I've watched a lot of extraction systems operate quietly and efficiently. Mortgages, credit cards, retirement products with 17 layers of fees nobody reads. But the modern car lease is something special because it doesn't announce itself as a trap. It feels like a smart decision. You drive a new car every 3 years. The payment is lower than a loan. No repair bills, no depreciation headaches. You hand it back, walk away clean, start fresh. Sounds like you beat the system. Here's what I want to show you today. The monthly payment is not the trap. The structure is. And the structure runs on 4 numbers that most people signing a lease have never seen broken out. Not because those numbers are hidden, but because you're never in the room where they're explained. You're in a different room. A room with comfortable chairs, coffee, and a very focused conversation about one figure on one line of a document that has many more lines. Once you see those 4 numbers, you cannot unsee them. My attorney has asked me to clarify, for the record, and he loves when I say, for the record, that nothing I'm about to say constitutes financial advice. He's a thorough man. He also leases his car. I've seen the contract because I've been doing this long enough that people show me things. I'll let you draw your own conclusions. What you're about to hear is the conversation nobody had with you at 25. Most people debate car leasing on the wrong battlefield. The argument is framed as a binary, lease or buy, as if both options are on equal footing, and the smart move is simply to run some numbers and pick the better one. That framing is the first piece of misdirection. A lease is not a financing method in the way a car loan is a financing method. A lease is a product, engineered by a manufacturer's captive finance arm, priced against actuarial tables they've spent decades refining, and sold by a team trained to direct your attention toward one single variable, the monthly payment. While your attention is locked on that number, 4 other figures sit embedded in the contract you're about to sign. They are technically disclosed. They are on pages 3 through 7 in the language of a financial instrument. They are not explained. They are not highlighted. They are assumed to be your responsibility to understand. Most people don't read financial contracts. That's not stupidity. That's human nature. The person across the desk has structured deals like this thousands of times. You've done it once, maybe twice, maybe 3 times. They know exactly where your eyes go, exactly which number makes you nod, and exactly how long to wait before sliding the signature page across the table. The deck is stacked before you sit down. Here's what's actually operating beneath the surface of that affordable monthly payment. Meet Daniel, 36 years old, earns $85,000 a year, mid-sized city, reasonable habits, sensible guy. He's been leasing cars since he was 28, 3 leases, 3 different vehicles. Always negotiated the monthly payment down before signing. He felt confident in the process. He did his research. He watched videos online about how to negotiate at a dealership. He knew to come in pre-approved. He knew to focus on the out-the-door price. He thinks he's good at this. Over 8 years, Daniel has paid approximately $42,000 toward vehicles, insurance not included. Fuel, not included. Registration, maintenance, not included. He owns zero of it. Not one bolt of any car. Not a dollar of equity. Not a single component he could sell tomorrow if his circumstances changed. His neighbor Marcus, same age, same salary, bought a 3-year-old sedan 8 years ago, paid it off, and has been driving payment-free for the last 3 years. Marcus doesn't think about it much. Daniel doesn't know about it at all. They park next to each other every morning. Now, Daniel is not careless. He is not unsophisticated. Daniel was played by a system that is exceptionally well designed, and he had no reason to question it, because every month the car worked, the payment cleared, and life continued normally. That's the trap. Not the contract. The feeling that everything is fine. Here's what Daniel never knew. A car lease contains a hidden interest rate. The industry doesn't call it an interest rate because the word interest invites scrutiny and comparison to other forms of borrowing. If they called it an interest rate, you would immediately compare it to your mortgage rate, your savings rate, your credit card rate. You would put it in context. You might push back. So instead, they call it the money factor. The money factor is a number that looks like this: 0.0018. It looks meaningless, a rounding error on something technical, a number you'd skip right past on the way to the payment line. Here is how you convert it to an actual annualized interest rate. Multiply by 2400. 0.0018 becomes 4.3%. 0.0028 becomes 6.7%. 0.0038 becomes 9.1%. Now here's the part that should make you put the pen down. The lender, typically the manufacturer's own finance company, sets what's called a buy rate. That's the floor, the minimum money factor they'll accept on any given deal. The dealership can then mark it up. They keep the difference as profit. And in most markets, they are under no legal obligation to tell you what the buy rate was or how far they moved it. You negotiated the sticker price. You felt the negotiation. You held firm. They came down $2,000. You shook hands and felt the satisfaction of someone who knows what they're doing. The money factor? You never touched it. You never mentioned it, because it was never named in a way that invited you to touch it. On a 36-month lease of a $40,000 vehicle, a money factor markup of just 0.0010 adds somewhere between $800 and $1,200 to your total cost. It arrives invisibly, dissolved across monthly payments, undetectable unless you know the formula. Every month you pay your lease, you feel nothing unusual, because the extra cost is not a separate line item. It is baked in. It is structural. It is the cost of not knowing one formula. That is villain number one. You might think, fine, I'll ask about the money factor next time. I'll negotiate it. Problem solved. Not quite. Because there's a second mechanism buried deeper, and this one operates in a direction you wouldn't expect. The residual value. When you sign a lease, the leasing company declares what the car will be worth at the end of your term. That number is the residual. Your monthly payment is essentially the difference between today's price and the residual, divided across the lease months, plus the money factor applied to the combined total. A higher residual means a lower monthly payment. Simple arithmetic. And a lower monthly payment is what makes you sign. But a higher residual also means this. At lease end, if you want to purchase the car, you're buying it at a price that was set by the manufacturer's finance team before you ever signed. and that price may be above what the market will support. Most people don't buy at lease end. They walk away. The manufacturer sells the car at auction, absorbs any gap between the inflated residual and actual market value, and folds that actuarial loss into the pricing of next year's lease portfolio. The loop closes. The math always balances. For them. And here's the other edge of this. When used car prices spike, as they did dramatically in recent years, a high residual becomes a buyout bargain. People rushed to purchase their lease vehicles because the residual was below market. The manufacturer took real losses on those deals. They adjusted. Residuals were recalculated. The system adapted in real time because they have the data to adapt. Decades of it. And you don't. You have one contract and a monthly payment you remember feeling good about. You are playing a game where one side has the rule book and the other side is focusing on the wrong piece of the board. So you see two villains, money factor markup, residual manipulation. And you think, I'll negotiate both of those next time. Now I know what to ask. Here's where the deadlock begins. Let's say Daniel has seen enough. He decides he's done. He's going to buy his next vehicle, finance it, keep it 8 years, pay it off, stop feeding the machine. Correct instinct. But Daniel is in month 22 of a 36-month lease. He wants out now. Early lease termination typically costs between $2,000 and $5,000, sometimes considerably more. You owe remaining payments plus a termination fee, plus any gap between the vehicle's current market value and what the lease structure says you owe. That gap is a real number. It comes due immediately. There is no installment plan for getting out of a lease early. You want out? You write the check. Fine. Daniel waits. He's patient. He runs out the lease. Month 36 arrives. He hands back the car. Clean break. Now he wants to buy. Here's the structural problem. 3 years of lease payments have contributed nothing toward a down payment, nothing toward equity in anything. He is in the same financial position he was in 3 years ago, with a salary that has grown modestly and vehicle prices that have grown considerably. The market did not wait for Daniel to be ready. The conventional guidance at this point is genuinely correct. Save up, buy used, pay cash where possible, minimize the loan term. I have no argument with that advice. Here's the deadlock. The average household is not setting aside the payment differential, the gap between their lease payment and some lower theoretical alternative, into a vehicle savings account. That money goes somewhere else. It always does. Rent went up. Groceries are more expensive. A medical bill arrived that month. A kid needed something. An appliance broke. Life expands to fill available cash. This is not a character flaw. This is not weakness or poor planning. This is a documented behavioral pattern across household financial data, consistent across income levels, consistent across decades of research. The money does not accumulate. It never quite makes it to the dedicated savings account. And so when the lease ends, the path of least resistance is right there, polished and convenient. A new lease, a lower payment than an equivalent loan, a familiar process, a new car that smells right and starts without hesitation. The dealership's finance team understands this cycle intimately. It is in their planning. It is in their sales training. It is in the timing of their follow-up calls during month 32 and 33 of your current lease. They call you before the anxiety sets in, before you've had time to research alternatives. They call while your current car still feels normal and comfortable. Because in that window, you are most open to a seamless transition rather than a deliberate decision. The call is not coincidental. The timing is a product of data, and the data is very good. The average lease customer, historically, returns for another lease within 90 days of the prior lease ending. 90 days. Not because they thought it through and concluded leasing was optimal, because the gap between leases is brief, financially uncomfortable, and the existing relationship with the dealership provides the most frictionless path forward. The system creates the conditions for its own perpetuation. This is what I call the perpetual renter cycle. You can drive for 30 years, pay more than $200,000 in transportation costs over your adult life, and arrive at the end with no equity, no asset, and a payment that simply never stopped. It just changed vehicles every 3 years, refreshed itself, and kept going under slightly different terms. Different car, same extraction. The system is not malfunctioning. It is performing exactly as designed. So what is the actual door out? Here's what changes the entire calculation. Not which product you choose. Not the lease versus loan binary. One shift in what you actually measure. Total cost of transportation. Most people know their monthly payment to the dollar. Ask someone what their car payment is and they'll tell you in 3 seconds. Ask that same person what they spend on transportation annually, total, comprehensive, every line item, and most will pause. Many will estimate. Most estimates will be significantly low. Research on household spending consistently shows the average American household spends somewhere between $10,000 and $12,000 per year on personal transportation. Per year. Every year. Run that out over 30 years of driving. That number, for most people, is genuinely surprising the first time they see it. Not alarming in a manufactured way. Genuinely surprising in a way that makes the decision framework look entirely different. When you start tracking the full annual figure, not the monthly, the full, the lease versus buy debate changes shape. The real variable becomes visible. And it's not the financing structure. It's the frequency of vehicle change. A new vehicle loses somewhere between 15 and 25% of its value in its first year. By year 3, total depreciation typically reaches 40 to 50%. After that, the curve flattens significantly. The car continues to depreciate, but at a much slower rate, sometimes just 3 to 5% annually. A lease covers exactly the steepest portion of that curve, years 1 through 3. And then you hand the car back and begin again at the top of the curve. You perpetually absorb the steepest part of the depreciation slope. You never reach the flat section. Think of it this way. Every vehicle has roughly 2 financial lives. The first 3 years, rapid, aggressive value loss. The next 5 to 7 years, slow, gradual decline. Leasing means you only ever live in the first life. You pay for the drop, hand it back, and start over at the top of the next drop. Historical data on lifetime vehicle cost per mile is consistent on this point. The cheapest car to operate is almost always the one you already own. Not the newest, not the one with the lowest payment, the one that's paid. I want to be specific here. I'm not telling you what to buy, how to finance it, or what fits your situation. Your numbers are yours. These are patterns in aggregate data, and patterns have exceptions. What you do with the math is entirely personal. But here are the concrete mechanisms that change your outcome at the contract level. 4 of them. 1 per villain, plus 2 for the fees that nobody names out loud. 1. Get the money factor before you sign. Ask the finance manager directly, by name, what is the money factor on this lease? In most markets, they are required to disclose it. Multiply the number by 2,400. If that annualized figure sits meaningfully above current auto loan rates, you are paying a financing premium, and money factor is negotiable within limits. You cannot negotiate a variable you've never been introduced to. 2. Understand the residual in both directions. A high residual lowers your payment, but sets a potentially unfavorable buyout price. A low residual raises your payment, but creates a realistic purchase option at lease end. Decide which scenario matches your actual long-term plan before you ever see the monthly payment. Because once you see the payment, that number will do its job. It will anchor you. Every other figure will be evaluated against it, and the payment will win. Decide what you want before the anchor drops. 3. Read the fee schedule. Every line. Acquisition fee, typically between $400 and $900, due at signing. Disposition fee, $200 to $500, charged when you return the vehicle. You pay it for the privilege of returning the car you were renting. Let that settle for a moment. You are charged a fee for giving the car back. Documentation fees. Gap insurance, often marked up significantly from its underlying cost. Excess mileage charges, built into the contract at a per-mile rate that becomes significant if your driving habits shift over 3 years. Life changes. Jobs move. A new commute adds 40 miles a day. The contract does not care about your commute. Wear and tear provisions that define normal wear in language specific enough to catch almost anything if someone looks carefully enough at turn-in. These fees, in aggregate, regularly total between $1,500 and $3,000, and they almost never appear in the advertised monthly payment. The advertised monthly payment is the price of admission. The total cost is a different number on different pages in smaller print. 4. Run the break-even before you sign. Total lease cost, monthly payment multiplied by the full term, plus every fee. Compare that to the total cost of financing a 3-year-old vehicle with a documented reliability record held for 7 to 8 years. The math on paper, done quietly at home, almost always looks different from the math you try to do in the showroom. Because in the room, with a friendly person across the table and a decision to make, the math that's hardest to do, clearly, is the most important math of the conversation. And the critical error, the one that resets everything, the one the dealership anticipates and builds its follow-up calendar around. Signing your next lease within 60 days of your previous lease ending without running this calculation first. That window is when the decision is most likely to be made on comfort and familiarity rather than math. The urgency you feel in that window is manufactured. It is not real. The car will still be there in a week. The deal will still be available. Interest rates do not meaningfully change in 7 days. Take the week. Do the math. Come back with the number, not the feeling. Let's close the circle. Daniel runs the numbers, properly this time. He discovers his last money factor was equivalent to 7.2% annualized, noticeably above what he could have borrowed at a credit union that same month. The difference, across 36 months, was just over $1,100. He never saw it. He never felt it. It arrived dissolved in monthly payments that always cleared without drama. He finds that the acquisition and disposition fees across his 3 leases totaled just under $4,000. Fees he could not have named the day after signing, because nobody named them to him during the signing. They were disclosed, technically. They were on the pages he initialed. He initialed them because everyone initials those pages. It's what you do in that room. He calculates his annual transportation cost for the first time in his adult life. 11,000 and change. Every year. 8 years running. He doesn't lease again. He purchases a 3-year-old vehicle with a strong reliability record. Finances it at a rate below what his last money factor would have cost him. Structures the loan for 4 years. Makes consistent payments. Does not extend the term to lower the monthly number. He pays it off in 4 years and drives it for another 5. In year 9, his monthly car payment is 0. His annual transportation cost drops by more than $4,000. Not because he earned more, not because he made some dramatic sacrifice, because he stopped absorbing maximum depreciation on a rotating cycle, stopped paying fees that were never explained to him, and stopped funding a product he didn't fully understand on terms he didn't set. He still drives a car, a good car, a reliable car, a car he owns. He just stopped renting the most expensive 3 years of every car's life, over and over, on a schedule set by someone else's actuarial table. This is how these things work. They don't arrive labeled. They don't announce themselves as traps. They feel like a reasonable monthly payment, a smart decision, freely made in a well-lit showroom with a friendly person across the table, good lighting, comfortable chairs, and a coffee machine in the lobby. Nothing about that environment is an accident. The comfortable temperature, the soft lighting, the finance office positioned after the car selection, so your emotional decision is already made before the numbers appear. None of it is accidental. It is designed. It has been tested. It is very, very good at what it does. The system isn't broken. It's working exactly as designed. And now you have something Daniel didn't have at 28. The 4 numbers, the formula, and the specific questions to ask before you sit down and before you pick up the pen. One question for you, and I genuinely want to see this in the comments. The last time you signed a car deal, did anyone at any point explain the money factor to you? Walk you through it? Name it out loud? Yes or no? I want to know how many Daniels are out there.